Roughly 1 in 6 American private sector workers is paid through this one company's systems. That scale built a fortress. But here is the uncomfortable question. ADP charges per worker processed. So if artificial intelligence starts thinning payrolls, does the very engine that made it mighty quietly run in reverse? The business keeps beating. Trailing revenue of $21.6 billion, net margin above 20%, earnings that lifted guidance in April. Yet the stock has been sold off roughly a quarter, from $315 to $242. Is that fear justified or opportunity? By the end, you will know how this payroll giant actually makes money, why its margins keep climbing while the share price falls, what its cash returns to owners, and whether a fair value range built from 3 models calls today's price cheap, fair, or expensive. ADP runs the plumbing of American payroll. Around that core sits a full human capital suite: benefits, tax filing, compliance, talent, retirement, plus a co-employment arm that rents small firms a Fortune 500 human resources department. Recurring fees, almost no capital intensity, and a huge pool of client cash in transit. Revenue splits 4 ways. Human capital management leads at $8.7 billion. The co-employment business adds 4.3. Human resources outsourcing 3.8, and the global unit 2.6. A further slice, roughly $1.2 billion, is interest earned on client float. Human capital management is the classic ADP, payroll and platforms sold from small business to enterprise. High retention per employee subscription revenue that compounds as clients add headcount. Note the co-employment line though. Much of it is pass-through benefits, so its headline growth overstates what ADP actually keeps. The growth record is the foundation. Revenue climbed from $15 billion in fiscal 2021 to $20.6 billion in fiscal 2025, with the trailing figure at $21.6 billion. That is about 8.2% compounded, steady expansion at a scale where many rivals stall. Earnings did considerably better. Diluted earnings per share rose from $6.07 to $9.98 over 4 years, reaching $10.73 on a trailing basis, roughly 13.2% compounded. Modest revenue growth, amplified into low teens earnings compounding. How does 8% revenue become 13% earnings? Margins. Gross margin widened from 46.5% to 50.8%, operating margin toward the high 20s, net margin now above 20%. Cloud migration and automation keep lowering the cost to serve. Returns on capital are where ADP separates from ordinary industrials. Return on invested capital has never dropped below roughly 24% in 5 years, sitting at 25.5% trailing, against a cost of capital near 8%, that is 3 times the hurdle, year after year. The balance sheet looks leveraged, only because most of it is client money held briefly in transit. Not ADP's capital, not its debt. Strip that out, and the corporate books are pristine, with net debt a mere fraction of annual cash earnings and interest coverage above 9 times. Profit arrives as cash and then some. Operating cash flow of $5.45 billion tops net income. Capital expenditure is a trivial $300 million, leaving trailing free cash flow of $5.2 billion. A free cash flow margin near 24%. The cash goes back to shareholders deliberately. ADP is a dividend king with more than 50 years of consecutive increases. The dividend per share rose from $3.70 to $5.89 in fiscal 2025, $6.64 trailing, yet still consumes under 60% of earnings. Buybacks handle the rest. ADP repurchased $1.79 billion of stock over the trailing year, trimming the diluted share count from 428 million in fiscal 2021 to about 405 million. Steady per-share value creation, without overpaying at cyclical peaks. Growth capital shows up rarely. Fiscal 2025 saw about $1.2 billion of acquisitions, chiefly the workforce software deal extending enterprise reach. a rare large check for a company that grows organically. Returns did not weaken, so that reinvestment earned its keep. The moat begins with switching costs. Payroll is the one system a company cannot afford to get wrong. Errors mean unpaid employees and regulatory penalties. Once ADP is embedded across benefits, tax and workflows, replacing it is disruptive, risky, and rarely worth the trouble. Retention stays high. Two more advantages reinforce it. ADP absorbs the fixed cost of tracking payroll tax across thousands of jurisdictions and spreads it over an enormous base no small rival can match. And paying a sixth of the workforce throws off billions in float income and a proprietary dataset competitors cannot copy. Still ahead, the fair value verdict and the single risk that could break it. For now, the rate backdrop is a quiet tailwind. With the Federal Reserve holding rates higher for longer, interest on that client float becomes real earnings support a pure software peer lacks. The cycle that matters is the labour cycle, and it is cooling. Recent data showed private sector hiring slowing and pay growth easing. Fewer net new employees means slower per-worker revenue, which is exactly why the stock derated even as earnings kept rising. The competitive story has shifted to artificial intelligence. Rippling is the credible cloud-native challenger. Workday, Paychex, and others press specific segments. ADP's answer is offensive. Its assist tool, the Lyric Enterprise platform, and the Workforce deal, casting automation as a margin engine, not a threat. Sentiment has turned decidedly cautious. At $242, the stock sits in the lower third of its 52-week range, down about 21% over the past year from a high near $311. The market is bracing for the labour slowdown. What could shift the mood? April's quarter offered a template, a beat paired with a raised full-year outlook of 6 to 7% revenue growth and 70 to 80 basis points of margin expansion. The next earnings print and ADP's own monthly jobs data are the swing factors. Three lenses frame the value. A discounted cash flow, starting from trailing free cash flow near $5.2 billion, growing about 6% for 5 years, then tapering to 3%, discounted at 8.5%, lands close to $265 to $270. The earnings multiple agrees. The stock trades at about 22.6 times trailing earnings, well below the 26 to 32 times it commanded from 2021 through 2024. A fair 23 to 25 times next year's earnings points near $255 to $290. Wall Street's own numbers set the bar. Consensus sees revenue reaching $21.9, $23.2, then $24.5 billion, with earnings per share of $11.07 rising to $13.34, about 10% annual growth. Today's price asks for less. Blend the three models, weighting cash flow and earnings most, dividends least, and fair value lands roughly between $240 and $280, midpoint near $260. At $242, the stock sits right at the low end. Interesting, not a screaming bargain. What would break the thesis? A structural stall in employment amplified by artificial intelligence. If client headcount plateaus, employer services revenue decelerates, and operating leverage runs in reverse. The observable trigger is revenue growth breaking below that guided 6 to 7% band for consecutive quarters. The related danger is that a genuinely superior automation platform commoditizes payroll, letting rivals win net new bookings. The tell would be retention slipping and gross margin, which has climbed to 50.8%, starting to crack. So far, the evidence runs the other way. A smaller risk points the other way. Aggressive rate cuts would squeeze that float income, which flatters current earnings. Set against all this, if hiring steadies while margins keep expanding, earnings and the multiple re-rate together toward the high end of the range. So where does that leave it? ADP looks fairly valued, shading toward modestly attractive. A wide-moat compounder growing earnings in the low teens, earning 25% on capital, returning most of its cash, yet trading at the bottom of fair value. The price reflects fear of a permanent labour stall, not actual decline. This is an educational analysis, not investment advice. Every figure comes from public filings and estimates that can change. Do your own research and weigh your own circumstances before making any decision. If this breakdown helped, subscribe. It genuinely supports the channel, and comment with the stock you want dissected next. Thank you very much for watching, and we'll see you next time.